Greetings from Three Edge Asset Management. My name is Fritz Folts. I'm the Chief Investment Strategist here at Three Edge, and I'm pleased to be joined here today by Steve Cucchiaro, President and Chief Investment Officer. As the global capital markets continue to be volatile, Steve and I wanted to reach out to our clients and once again provide a very brief take on the markets as of the close on Tuesday, March 17th. So currently, Three Edge Asset Management is adhering to the CDC guidelines. We are operating remotely. We're using actually something called Microsoft Teams platform. It's working quite well. So we're able to do everything we need to on behalf of our clients. So we had a short video last week, Steve, and in that video, we already mentioned that we were defensively positioned prior to the decline we've seen in the markets that began in mid-February because our model research was indicating that markets were overvalued. Well, I also remember that we wrote a piece in mid-February. You wrote that, talking about the next bear market. And so here we are, that we're about a month into this and markets have declined significantly. So I have 4 questions that I'd like you to answer for our clients if you don't mind. And so here we go. First question. We thought markets were overvalued. That's why we were defensive. Are they still overvalued?
So you're right, Fritz. Before the coronavirus hit and the oil price war hit, we thought markets were 35 to 40% overvalued based on metrics that we've used that have been reliable over a long period of time. Peak to trough, this bear market was the most rapid decline of any bear market in history, even more rapid than the 1929 crash. However, while we're a lot closer to fair value than we were just a month ago, based on our metrics, we're still slightly above fair value.
So we're not quite there. Okay, here's my second question, and this is about bear market rallies. This has really been wild. On Friday, the market went way up. On Monday, it went way down. Today, it's recovered somewhat. It's done better. So these bouts of volatility are just kind of crazy. And are these all what we would define as bear market rallies? And what does your experience tell you there?
Well, while all bear markets have their own characteristics, there are similar patterns and similar attributes to different bear markets. We've studied every bear market since the late 1800s. What I can tell you is that this resembles other bear markets in 2 ways. One is during the bear market, you not only have some of the biggest down days in history, but ironically, you have some of the biggest up days. So it's not so surprising. Now, the fact that we're going up and down more than 10% in many of these days, that's extraordinary. That's even more than what happened in the financial crisis of 2008. But it is characteristic of bear markets. Secondly, bear markets follow a pattern where initially you get a sharp drop, and then that is followed by a relief rally. Oftentimes, the relief rally can take the market back some percentage of the drop, but often it's just enough to excite people thinking they've hit the bottom, and it draws money back in. And if the underlying problems aren't fixed in short order, they set people up for further losses down the road.
Great. My third question, and this is one that I think everybody's thinking about, is when is it time to get back in? When is it really the appropriate time? How do you think about that?
Based on emails I get, based on lots of reading that we've done recently, so many people are asking the question, is this the time to get in? Is this the bottom? And frankly, at the bottom of other bear markets, people are usually not asking that question. Usually they've been so beaten up that people are just still looking to get out and they've had enough and they might never want to invest again. So it feels more like we could be on the verge of a temporary bottom, and maybe we get a relief rally from here that takes us up a bit, but probably not the final bottom. The longest or the steepest bear market we've ever had was in 1929. And believe it or not, there were 7 bottoms. 6 of them were temporary, only to lead to a relief rally that then fell apart and went to new lows. Only the final 7th bottom was true.
Wow. And that was a decline of 85% overall then, right? Somewhere around there.
That's correct. And the very first bottom happened a couple of months after the crash of 1929. And the market went up quite substantially, about 16%. And many were convinced everything was fine. And then, of course, those people lost a lot more than they did even in the initial crash.
Great. Final question, and this is sort of the elephant in the room a little bit. In terms of the spread of the coronavirus and COVID-19, and I mean, clearly this is not to make light of it because it's a human tragedy. But in terms of the market, sort of what we've learned recently and where the market is, how would you think about that?
So there seem to be two camps, two schools of thought about how the coronavirus might continue to affect the economy and the market. One is a more optimistic view where in a month and a half, new cases will peak and then things will get less worse or slowly better.
Right. Yeah.
And the idea that's optimistic is that the monetary and fiscal stimulus that's been promised and discussed, and some of it has already happened, will be enough to bridge over this very steep decline in demand so that we don't need to get big unemployment, people don't lose their mortgages, et cetera, and companies don't get into a debt crisis. And we get over the bridge, and then it's life back to normal. Now, for some people, they thought the market was fairly valued before the crash. We think it was overvalued. So we don't think that the market goes right back to where it was. But those are the people that are especially anxious to get in at the bottom. Their fear of missing the bottom, FOMB.
Right.
However, there's a more pessimistic side, and I do need to explain that. Even though fiscal and monetary stimulus looks very, very strong, we're talking about trillions of dollars of stimulus, not billions, but trillions. It remains to be seen with the severe isolation and lockdowns, the hit to economic demand could be so serious that we get into a debt crisis. Before this all happened, so many companies borrowed money with incredibly easy terms, but instead of building their balance sheets and saving for the rainy day, they use that money to buy back their stock at much higher prices than we have now. And if we end up having a debt crisis where companies have to sell assets and sell stocks and delever, then that selling will form a vicious cycle, and the debt crisis could continue and make this a much more prolonged bear market. So we have both scenarios, and because even the health experts are having trouble pinning down how long this might take, we have widely diverging ideas of what might happen to the stock market and economy. So our thought is be careful. Don't put all your eggs in one basket. Maybe things are in the optimistic side, maybe not.
Great. Well, thank you very much, Steve. And that will do it for this brief update on global capital markets. Of course, as clients, please feel free anytime to reach out to us, either via email or over the telephone, and we would be glad to impart our outlook for you as we go through a volatile period in the market. So, Steve, thank you very much for that update. And we will, I'm sure our paths will cross again soon, and we will be back online and on video or recording other messages as we go forward. So thank you.
Thank you all.